Dear investors, over the past 3 years, gold has gone up from about 60,000 rupees to around 1.5 lakh rupees per 10 grams. An extraordinary return by any standard. Naturally, it has become one of the most talked about investment themes.
Price of gold.
Gold market.
Among the major investment asset classes, it has delivered one of the strongest returns. Naturally, the question now is what comes next for gold? Will the prices correct? Can the rally continue? Whether one should wait before allocating or has the opportunity passed? So, in this video, we'll cover three most important questions about gold. First, what are the different ways of investing into gold? What are the pros and cons of each? And importantly, how much does the taxman take away? I'll also touch upon SEBI's cautionary note regarding one particular mode of investing in gold and the key risks investors should be aware about. Second, what is the ideal allocation one should have in gold in the portfolio? And third, and the most important ones, should one invest into gold at the current levels? Well, quite honestly, here we are not going to try and predict how gold prices will move next, but the idea is to understand how to look at gold when investing. So let's get on with this video and let's try and understand why gold prices have moved up so much and what structurally changed. You see, between 2023 and 2026, central banks added around 3,000 tons of gold to their reserves, which on an average is around 1,000 tons a year. The global average annually before that was about 475 tons a year. So buying has more than doubled. These are not speculators or short-term traders. These are world's monetary authorities, institutions that manage national reserves, systematically moving it for gold as a strategic reserve asset. As per World Gold Council estimates, 87% of 2025 buying went unreported. Countries like China and Russia routinely delay disclosures. The real number is most probably much higher than the official one. If you look at this table, you can see who's buying. Countries like Poland, China, India, Turkey have all been big buyers, but most of the developed countries like the USA, Germany, France, Japan haven't really bought anything. Russia, in fact, has been a net seller lately. And critically, this is price insensitive demand. They were buying at 60,000 rupees, they're buying at 1,50,000 rupees as well. That kind of demand puts a structural floor under gold that didn't exist a decade ago. So that's what has happened. The deeper question is why? Why are the world's most conservative institutions piling into gold at this scale? That's where the story gets interesting. For decades, the US dollar served as the undisputed global reserve currency. Central banks held dollars not because they particularly wanted to, but because the global trading and financial system ran on dollars. Oil was priced in dollars, trade was settled in dollars. US Treasury bonds were considered the safest asset in the world. Then, on 26 Feb 2022, 3 days after Russia invaded Ukraine, Western nations did something that has never been done before at this scale. They froze approximately about $300 billion of Russia's central bank reserves held in Western financial institutions. Overnight, a sovereign nation's reserves held in what were previously considered world's safest assets became inaccessible. The message to every other central bank was very clear. Dollar reserves are not truly yours if geopolitics turns against you, whereas gold cannot be frozen, sanctioned, or cancelled. And that's been one of the major reasons why central banks started buying more and more gold. Actually, when currencies, governments, and the global based financial systems all come under simultaneous stress, gold acts as an insurance, a hedge because it is no one else's promise to pay you back. You can see in the table that the dollar's share of global foreign exchange reserves has fallen from approximately 71% in year 2000 to 58.4% in Q1 of 2025, the steepest sustained decline in dollar dominance since the Bretton Woods system, which ended in 1971. The share of gold in central bank reserves in the 1950s was very high. It fell as central banks moved to dollars, and now again, the percentage of gold in central bank reserves is increasing. According to the IMF COFOR database, the shift is accelerating, not slowing. For investors, the investment implication is quite straightforward. This is not a temporary trade. These are sovereign wealth decisions made over decades. Gold's role as a sanction-proof, universally accepted store of value, one that cannot be frozen by any foreign government, is now a mainstream consideration in global reserve management. That demand is structural, durable, and price insensitive. Now, I want to show you why gold returns for Indian investors are higher. Gold is priced globally in dollars. So every time the rupee weakens, gold in rupee terms get more valuable, even if global gold prices don't move up at all. And just for you to know, the rupee has weakened against dollar in the last 40 out of 50 years. It's structural, driven by India's higher inflation. Owning gold in India isn't just a bet on gold, it's a built-in hedge against your rupee losing purchasing power. So gold rose and the rupee pushed it further for you. The natural question now, how does that actually compare to everything else that you own? Equities, EPF, fixed deposits, debt mutual funds, and inflation. Let's compare. Now, when you look at this table, what clearly stands out is the returns from gold for the past 3 years, which is roughly in the range of about 30 to 35% compounded. If you see the returns of gold versus equity, the past 50 to 25 years, equity returns have outperformed gold return. Now, let's go back to 1st of Jan 2020 and look at the trailing returns from that vantage point. No COVID, no 2023 to 2026 rally, just raw historical data. Notice this table and see what happens when you remove the benefit of hindsight. As of 1st Jan 2020, gold's 3 and 5 year trailing returns were lower than most categories, and 10, 15, and 25-year returns were lower than equities. Here, I'm only considering large cap returns, but if I consider the returns of multi-cap segment, the gap between equity and gold returns will increase further. And investors sitting on that date, looking backwards, have had almost no data-driven reason to go overweight gold. Now, let me show you 5 significant corrections in gold over the last 75 years history. This is not to scare you, but for you to understand how much can gold correct. You can see in this table that over the past 75 years, gold has undergone corrections ranging from about 20% to about 70% across different cycles. Every single correction in gold eventually recovered. Sometimes it took years and maybe decades. Now, the most important thing which deserves attention here is the Jan 2026 correction. Gold declined by about 20% in dollar terms in just 6 weeks. What made this correction particularly important was that it did not follow the usual pattern. I mean, during the Middle East crisis, gold was widely expected to strengthen as a safe haven asset, which it initially did. But once the central bank buying started to moderate, which happened, you see that the prices corrected sharply. This episode highlights an important point. A significant part of the 22 to 25 gold rally was primarily driven by aggressive central bank accumulation. Now, if that structural demand slows down or does not continue for any reason, gold prices could remain range bound or could appreciate at a much lower pace, unlike the strong rally we witnessed over the past 3 years. Showing you this data is deliberate. The current environment may be tempting you to go overweight on gold based on what it has done recently. But the historical view is useful to know how deep the correction can be. Also, the message here is not that gold is unreliable. The message is that gold can sit flat for longer periods of time and then can move sharply. Now that we've understood what has driven gold's rise, why returns are higher in rupee terms, how it compares versus the other asset classes, and how it has behaved across various cycles, let's come back to the 3 key questions we started with. Now the big question, what is the best way to invest in gold? There are broadly 4 options: physical gold, gold ETFs, gold mutual funds, and sovereign gold bonds. Now here in this table, we've given a comparison of all these 4 options across different features. So please go through the table in detail, but I will summarize that for you. All 4 are linked to gold prices, but the difference lies in cost, taxation, and convenience. First, let's talk about physical gold, which also includes jewelry, coins, or bars. Now this is good for emotional ownership, relationship, weddings, and family use, but very expensive as an investment because of the making charges and the 3% GST and the storage cost. Now, tax wise, if you sell physical gold before 24 months, gains are taxed at your income tax slab, and if you sell it after 24 months, it is long term capital gains tax and is taxed at only 12.5%. So, good for sentiment, not the best for fresh investing. Now, let's come to gold ETF. Now, this is probably the most efficient option for many investors because there are no making charges, no GST, lowest cost, and easy liquidity through your Demat account. The biggest advantage here is that the long term tax starts just after 12 months and long term capital gains tax is only 12.5%. Now, for most investors, this is probably the best way to own gold. Now let's come to the third option, which is gold mutual funds. Now this is very useful if somebody wants to do an SIP investment or if they don't have a Demat account. This is very convenient, but this is slightly more expensive than the ETFs. Tax wise, long term starts only after 24 months, unlike ETFs. And finally, sovereign gold bonds, probably the best post-tax product India ever created. You got 2.5% interest plus gold returns, and if it held till the 8-year maturity, gains were fully tax-free. But there are no fresh issues since 2024 and secondary market buyers don't get the same tax advantage. So the simple takeaway, for jewelry, it is physical gold. For fresh investment, it is gold ETFs. For SIP and people, those who don't have Demat account, gold mutual funds. And if you own sovereign gold bonds, hold them carefully because the tax benefit is very valuable. Now, knowing this one is very important. There's a category of gold products growing very fast on every smartphone, and most investors don't realize what they're actually buying. So, SEBI in November 2025 cautioned investors about buying digital gold or e-gold through digital platforms like PayTM, PhonePe, India Gold, Gulak, and many similar apps. Now, these offerings aren't regulated like ETFs or mutual funds, which means there's no oversight on how the gold is stored, who actually holds it, or what protects you if something goes wrong. Convenient, but you're relying on the platform's promise rather than a regulated structure. This is unlike ETFs or gold mutual funds, which mandatorily have to buy physical gold and store it in vaults, and it is reported to SEBI. As a general rule, before putting serious money into any of these gold products, check whether it's regulated, who holds the underlying gold, and what protection exists if the platform fails. Right framing first. Gold is not an income generating asset, no dividends, no earnings. It's a store of value and a hedge against currency depreciation, geopolitical instability, and systemic financial stress. Once you accept that framing, the sizing question becomes clearer. The institutional standard is 5 to 10% of your portfolio. This is not arbitrary. It reflects decades of portfolio construction research on the optimal weight of a non-income generating inflation hedging asset that one can have in a diversified portfolio. One important note on how to count this: exclude family jewelry. You won't rebalance it based on portfolio targets. Count only investable gold, ETFs, sovereign gold bonds, gold MFs, coins, parts that you would actually sell. So you know the right percentage. Now to the question everybody came to hear. Is 1.5 lakh still a good entry point? Honest answer: nobody can tell you reliably where gold would be in 6 months or 1 year or 2 year or 5 year. Anyone giving you a precise target is speculating, a guess in confident packaging. The question isn't whether 1.5 lakh is cheap. The question is whether your portfolio is positioned to negate the combined impact of geopolitical risk and your risk tolerance based on your investment objectives. A meaningful part of the easy returns from this gold cycle has already played out. The next phase, if it comes, is more likely to be patient and time-led rather than sharp and momentum-led. Adjust your expectations accordingly. The real variable here isn't price, it's behavior. Gold rewards patient holders who buy with a very clear reason and hold it through corrections and time periods. It punishes momentum chasers who get in at peak and sell when the panic sets in. Don't ask what gold will do next. Ask what role gold is playing in my portfolio. If you would want to have a more structured perspective on your portfolio across equity mutual funds, gold, debt, tax implication, and overall asset allocation, feel free to connect with us at Reliable Wealth. The link is in the description. We are happy to offer you a 30-minute portfolio review with no fees and no obligations. At your scale, what you don't know would cost you more than what you really do.